I'm Kyle Tetting, Director of Research at Landaas Company.
Kyle, I want to talk with you about stock market volatility. We usually hear about that when the stock market indexes are going down, but let's clear that up. There's more to it than just when stocks sell off, right?
Absolutely, Joel. Volatility doesn't strictly measure those down days in the market, but I think that tends to be what we hear about in the financial press. You string a couple of pretty significant declines together, and all of a sudden everybody's shouting how volatile things are. But it's important for investors to remember that volatility can be on the upside as well, that you can have big swings higher. You measure volatility all the same.
And how do you measure volatility?
So one of my preferred ways to look at volatility is to just simply count the 1% swings in a particular index. And we used to be able to say you count a 100-point move in the Dow as a day that's pretty volatile. Yeah, 100 points was a big deal back when the Dow was at 10,000, but we're a long way from there. And so if we get back to that 1%, a nice round number to say, here's a day that's a little bit more than just calm. You can start to count those up. You can start to put those 1% days together, compare those to history, compare those to some averages to get an idea of, are we witnessing more 1% moves right now, this month, this quarter, this year, than we have in previous months, quarters, or years.
And what do you learn from that?
Joel, I think it's important to remember that what we're measuring is what has happened. And so it tells investors a little bit about what markets are doing, but of course it doesn't tell us direction. It doesn't tell us if those things are up or down. And it doesn't tell us much about what to expect going forward.
So what do you do about that going forward?
So the Chicago Board of Options Exchange puts out the VIX, or the Volatility Index. And that is a measure, a forward-looking measure of volatility. It tells us what volatility is going to look like over the next 30 days, or perhaps what it should look like over the next 30 days, because nothing's a perfect predictor. The challenge there is it's a very complicated measure, and again, it tells us nothing about direction. It tells us a lot about what we should expect, what investors think is going to happen with volatility, but very little about whether that's going to be to the upside or to the down.
Why should investors care about volatility?
I think what volatility really brings to the forefront is investors who maybe aren't properly allocated. It's one thing for the markets themselves to bounce around, but if you also see your portfolio bouncing around more than you're comfortable with, that probably points to an allocation that's not correct, or an allocation that isn't tailored to your risk tolerance as an investor. And the most important takeaway for investors is to just make sure that if they're seeing volatility, is it volatility in their own portfolio, or is it volatility in the markets?
And then what can they do about volatility?
Joel, if it is volatility in their own portfolio and just not volatility more broadly, then the next question is, have we gotten risk tolerance correct? Have we made that measure? Have we asked those questions of ourselves to make sure that we're taking an appropriate level of risk? And if the answer to that is no, that our portfolio is exhibiting more fluctuation than we're happy with, then we need to take some steps to really figure out what it is we should be putting in our portfolio. And that often means introducing more diverse asset classes, bringing in bonds if you're too heavy in stocks, bringing in non-US stocks if you're too focused in the US, to truly build a balanced portfolio.